Final accounts. In this class, I am going to guide you what are the components are there in final accounts. Then how can we prepare and what are the items will come in each and every component. Final accounts of three segments may be possible in general. Final accounts. Trading account, P&L account, and balance sheet. These are the three segments in general. What are the balance you get in trading account is named as GP, transferred to the P&L account. The balance in P&L account is named as net profits, transferred to balance sheet and added to owner's fund. Okay, net profit. This will be available or suitable for trading concern. For trading concern. If I am being a manufacturer, trader means I purchase and sell. Purchase, add some markup, profit is added and sell it. But I am not purchasing. I am purchasing the raw material, converting the raw material into the finished goods. And then I am selling the finished goods. What happens now? Right. In case of manufacturer. In case of manufacturer. The final accounts of three blocks. One is all about manufacturing account. Manufacturing account. Second one is all about trading, and then third P&L account, finally balance sheet. Okay. Trading account and profit and loss account and then balance sheet. So we have three blocks. By telling the manufacturing account, the balance what you get, named as cost of production. Like similar to the way we spend the money for purchasing from outside. Right. So we spend money for purchasing. If I am running a furniture mart, I can purchase the furniture for 10,000 rupees. By adding 2,000, I can sell it for 12,000 rupees. Right. Rather than that, I can purchase the furniture, the raw materials for the furniture, wood. That wood, steel, plastics, whatever it may be, converted that into the table and then I am selling it. The conversion portion is separately identified by preparing the manufacturing account. By tallying that, we'll find out what is the cost we spend for manufacturing. That cost of production is identified here, that is transferred to the trading account, cost of production. COP, cost of production. With that cost of production, I just add some profit and sell to the outside. Okay, because of that I get GP, the GP is transferred to the P&L account, and then on tallying the P&L account, the balance what I get here is net profit transferred to the balance sheet from this. This is the logic. In case these two businesses are related to a single owner, sole trade business, sole trader, sole proprietorship, whatever it may be named, only one person is there. Whatever the result only for the owner, salary, commission, interest on capital, profit share, everything is for the same person. I am the only owner. I take salary. If I take salary, what happens? I debit that salary to the P&L account, the profit will go down. Profit is reduced. My net benefit is salary and net profit. If I don't take salary, net profit will be higher. Both will be for me only. Whatever name may be, salary, interest on capital, commission, and whatever the interest on capital, whatever it may be, everything is for the owner. No problem. In case of partnership, what happens here? There may be n number of persons. This net profit will be shared by business day long. Another fellow says, sir, I invested huge money. Another person says that I showed so many contacts to build your business. And all the partners put together sharing the risk. As per their contributions to the organization, they have to be given some benefit. Say, three partners, A, B, C. A is taking care of the business by monitoring day long. Okay, day long. He is the working partner. Okay. And B could not work daily, but he has huge money with him. So he invested higher investment other than others. So A invested 1 lakh, but B invested 5 lakhs. So financially, he supports more to the organization. C has no time to spend for working and also has no money for spending. But he says, I have the good contacts, sir. Whatever the product you prepare or manufacture, I could show the customers to buy. Then they will simply use their contact to develop our business. And all the three partners are now responsible for the result of it. Result may be either positive or negative. In case of negative, A, B, C are responsible to take care of that. So don't worry. If there is a loss, we will be taking care. That's how my partner also takes responsibility. Profit is no problem. In case of loss, who is going to take care of that? My partner says, sir, 50% loss I may share. That's what about risk taking ability. Risk taking ability. So for the organization, when we have few partners, the few partners are contributing the organization in a different way. Maybe financially, maybe physically, maybe contact wise, maybe shouldering in case of negative sense, in case of risk, in case of loss. Don't worry, I'm here. I'm here. That's how they'll support. As they support for the organizations, they demand something, right? What do they demand? Give me something for my contributions to the organization. Working partner will get what? Salary extra. Salary extra. The partner who gives more, probably in bank I can get some interest. A says, instead of taking care of this business, if I work somewhere, I get salary. I'm losing the salary you give me. B says, I could have invested in the bank, in FD or savings bank, at least I may get some interest. Give me that interest. Okay, I will give interest. And contact. If I show this contact to my competitor business, they will give me commission. Okay, based on the sales volume, 10% or 5% commission may be given. So here commission. Okay, risk. So we are taking the risk. In case of loss, we have to share. No issues for the risk taking. Whenever there is a profit, we'll offer you a share of profit. So profit share, profit sharing ratio. Whatever the net profit you get, will be shared among all the partners based on their contributions to the organization, prepared by way of P&L appropriation. After appropriating the profit to the various partners based on their own contributions to the organization, right? To their organization, whatever the amount left over, also be considered as profit and loss, should be shared. How can we now include that in the capital account? Okay, so salary, interest and commission, profit sharing ratio, as per the profit sharing ratio, profit distributed should be given to them, right? To them only. So that will be separately identified by preparing capital account. So these two extra will come in case of a partnership after the P&L account, before the balance sheet. After the P&L account. So whatever the net profit we found out by preparing the P&L account is shared by the old partners based on their contributions. So in most important cases, we may have 6 blocks also: manufacturing, trading, P&L account, P&L appropriation account, and capital account and balance sheet. In case of company also says the profit is going to be shared to various contributors, like preference shareholders will demand some dividend, equity shareholders will demand some dividend, and government expects some share in taxation, and some money may be kept aside for the future requirement, reserve, and leftover can be carried over for the next year's usage. So all these things are identified or prepared in a new account called P&L appropriation. So hope now you'll be able to understand. The final accounts will be of 4 or 5 segments: manufacturing, trading, P&L account, and balance sheet default. After the P&L account, we have 2 more blocks. If it is required, then we can prepare based on whether it is for the partnership firm or company. Clear? Now, from the trial balance, we are going to prepare, okay, final accounts. TB to final accounts. The final accounts will be of 3 segments. Okay, trading, P&L account, and balance sheet. TB will have debit and credit. Debit and credit. In debit side, we may have assets and expenses. In credit side, we have liabilities, capital, and income. Okay, okay. These are the items are available in trial balance. Clear? Capital and income. Clear. Now, this will be a no problem for you. This will be a no problem for you. Isn't it? This will directly goes to where? Balance sheet. Okay, assets, liabilities, and capital will go to the balance sheet. When it's all about income and expenses, then a small subclassification is required. What is that? Those items related to the trading account, those items related to the P&L account. Is that okay? This classification is very, very important. Clear? Now, how can I classify this being the assets, sir? The payment gives benefit more than 1 year. Benefit is more than 1 year, then it is an asset. If the payment is giving the benefit less than or equal to the financial year, before 31st March itself, we can enjoy the benefit. Thereafter, I don't have any privilege to enjoy in the subsequent period, then it's a expenses. Is that okay? Similarly, in liability side, whatever the receipts you do, whatever the receipts you get the amount, right? The for that you have to work for. I'm getting the fees from you. For that, it's my responsibility to teach you, right? How long? Until the batch gets over, right? So the batch gets over a matter of 6 months or extended to 1 year. That's all. So within 1 year, I can enjoy all the benefits. The commitment for working for you is over by the year end. By the year end. Is that clear? If I borrow the loan from the banker and the banker says you have to repay in 20 installments in 20 years. So what happens? I received the money, but I'm liable to pay the interest for 20 years, right? Hope so you could not understand. The receipt that gives me a commitment less than 1 year, less than 1 year. I receive the fees. My commitment is to finish up the classes in 6 months. That's all. Then this is my income. And the commitment is more than 1 year, like loan borrowed. For that I have to repay in 20 installments over 20 years period. Until the last payment is over, I have to pay the interest also. I'm committed for that. So then it is liabilities or capital. Liabilities or capital. Is that clear? If I'm getting the money from third party, then it's a liability. From the owner, if I am means I'm talking about the business angle. We are accounting for the business only. For the business angle, I'm getting the money from where? Either it may be from probably owner or third party. If it is being from third party, then it's a liability. If I'm getting it from the owner, then it's capital. Clear? Hope you'll be now able to understand. Once you identify it may be in income and expenses or other way. If it is being the income and expenses, now subclassification. Will it come in the trading account or P&L account? Will it come in the trading account or P&L account? So, Mr. A purchases from Mr. X. Okay. And later on, he adds some profit and sells it to Mr. Y. The cost of purchase being 1,000, it should not come automatically from the seller's place to your place. You have to either incur for the freight and carriage or some other reason, some other cost, maybe around 100 rupees, and some other wages you paid for loading, unloading in the tempo, whatever it may be, that cost, and bring it and keep that in your shelf. For that you may still spend some other unloading, and the product what you have purchased may have some extra process to be done in our place. Okay, cannot be sold as it is. Repacking, because bulk purchase I do, retailing, no, I have to dismantle and make small packages, and all these things again involve some costs like power and fuel. Okay, all these costs up to this point, that means the product is ready for sale, ready for sale. Okay, the purpose of purchasing this for sale only. No, the intention of purchase is to sell, to make a profit. The intention is completed the moment it is ready. It's stored in the storeroom, means the showroom. Could take around 2 or 3 months also for the sale, right? You visit some shops, some products may be in the shelf, may not be saleable immediately. It takes at least 3 years, 2 years, maybe, right? Until the time the product may not be saleable. For 2 years and 3 years, the product's there only, right? For that space, rent, electricity, lighting, and an attendant to clean that product, to safeguard. All these costs, those things are recurring in nature until it is sold, will be a P&L account. P&L account item. So this will go to the trading account. This part, thereafter, whatever the cost you incur after the ready for sale to the product reaches the customer's hand, whatever the cost you incur is the profit and loss account item. Clear? Apart from that, financial items like interest and all will also come here. Clear? Hope you will be now able to understand. Now, before preparing the final accounts, here you have some more component to be adjusted. One is adjustment entry. Another one is you have to understand transfer entry. Transfer entry. Okay. Adjustment entry means as on 31st March, as on 31st March, you could have enjoyed some benefits, but the payment is not made. Right? When you go to the hotel and order, okay, you order, you will finish up eating, say in 2 hours or 1.5 hours. If you are gathering as a party, for a party, what happens? You spend there for 2 hours. The moment you order, you started enjoying the benefits. Have you paid? You'll pay at the last only. No, the bill is at the last only. As such, on 31st March, you may enjoy the benefit, but the payment is still pending. But that is the expenses for the period. The payment is pending, but that is the expenses for the period. Those adjustments, outstanding expenses. Sometimes payment made in advance, you can enjoy later. Expenses paid in advance. And income received in advance, income supposed to be receivable. Those things are going to be done slight adjustment. What are the debtors we have? There may be slight doubt whether the amount is collected appropriately, or there may be some chances of losing that amount, also named as bad debt. And sometimes they may demand, sir, give me some discount, also may be possible. Okay, all these things are going to be finalized on 31st March. That is called adjustment entry. That is called adjustment entry. Clear? Transfer entry is nothing but transferring these income and expenses to the trading and P&L account, is called transfer entry. All the income and expenses, identify the income and expenses. Okay, all the income and expenses should be transferable to the trading and P&L account. But balance sheet is only a summary. We no need to pass a transfer entry here. What about here? Transfer entry is not required, but in this case, transfer entry is required. Is that clear? But anyhow, in our regular study, understand there's a transfer entry, but of course we are not going to pass a transfer entry. Rarest case we understand how to pass a transfer entry. Otherwise, you no need to use it always. So the transfer entry could be, all these things are debit item. To cancel the debit item, okay, because transfer means debit is going to be, this expenses is going to be closed and it will go to the new account. Expenses is a debit balance, right? To transfer, this is going to be credited, and where it is transferred, no, that account should be debited. So for example, it may be either transferred to trading account or P&L account, depending upon the nature of spending to the expenses. This is what about the transfer entry. For the income, the entry being income account debit, because income is in the credit side, right? So credit balances, to cancel the credit, it should be debited. So income account debit, where it is transferred, either it may be in trading account or P&L account. That's how you can understand. Clear? So this is the small background of the final accounts here. Now, what sort of the adjustments may be possible? Right. What are the things are going to be studied here? Let's see. Number one. In this class, I am going to teach you how to finish a basic illustration, closing stock with closing stock. Okay. Closing stock based adjustment. One is we solve in a usual model. Okay. Usual model. Applying the transfer entry model. What is that? Transfer entry. Transfer entry means transferring to trading and P&L account. Either it may be to the trading account or P&L account. Second one is you can pass this as an adjustment entry. It means the stock will be adjusted in the purchases account and then we'll pass on to the next process. That is called adjusting entry. So we'll understand these two. Okay. Now, when we pass on the adjusted entry, automatically what happens, trial balance will have the closing stock not in the adjustments. The closing stock will appear in the trial balance or outside the trial balance, right? Second one is all about some outstanding or advances related to the income and expenses. That part will be studied. So these are the two segments. Here also, we directly do just a plus or minus, like next one is routed through a proper adjustment entry. In both the way we'll understand, right? Both the way we'll understand. You have to understand what's that. Okay, you have to understand these adjusting items may appear below the trial balance or inside trial balance. Clear? Below the trial balance or inside the trial balance. You have to understand when it appears below the trial balance or inside the trial balance. I am going to guide these two. How can we pass the entry or pass the adjustment entry and all, or how can we prepare the final accounts in case of this model or in case of this model? So both the way we'll understand. Clear? Let's now start. So we have stock in trade and outstanding expenses, prepaid expenses, accrued income or outstanding income, unearned income, depreciation, interest on capital, interest on drawings, and hidden adjustments. These are the 10 adjustments. Bad debt, provision for doubtful debts, provision for discount on debtors, reserve for discount on creditors. These are the 14 journal entries you have to understand. Clear? Once you are master with these 14 journal entries, I will give another 7 additional journal entries, special journal entries. Okay? All these journal entries will be passed if the adjustments are given below the trial balance. If these things are within the trial balance, how can we pass? So both the way we are going to handle this. Clear? Let's start with stock. Start with the stock. Stock. When we have the closing stock, what happens? Listen. In case of stock, if it is given below the trial balance as an adjustment or given in adjustment, okay, or given in the trial balance, if it is given in adjustment, you can simply pass transfer entry. Of course, we can skip that one also, no problem. Usually, transfer entry is not required, but you have to understand the logic of transfer entry. Okay, transfer entry. The closing stock will appear in the trading accounts credit side as well as the balance sheet. Further, the journal entry being for closing stock. Stock in trade account debit to trading account. Clear? In case of opening stock, trading account debit to stock account. That stock is all about opening stock. Clear? This is the transfer entry. If this one is appearing in the trial balance, it is actually an asset. In case of asset, it will directly go to the balance sheet asset side. Directly goes to the balance sheet asset side. You no need to pass any journal entry for this. Now the question arises, why this closing stock sometimes appears in the trial balance, sir? Why it is not so? So, the reason why this appears in trial balance is nothing but we might have passed the adjustment entry. Clear? If the adjustment entry is already passed, the closing stock appearing the trial below the trial balance will become a part of the trial balance item. Part of the trial balance item. In that case, how should that be? How should that be? Is that okay? In this case, opening stock is going to be added with the purchases. Closing stock is subtracted from the purchases. Keep this idea in your mind. Purchases is a debit balance. Purchases is a debit balance. If I want to add with the purchases, okay, again nothing but debiting the purchases. If you want to subtract the purchases, then it is a minus item. It means you have to credit it. Already purchases shows 1 lakh rupees in debit balance. Further debiting another 10,000 raises the purchases balance by 10,000, 1 lakh 10,000. If I am subtracting 15, that 1 lakh is mine now subtracted by 15, thereafter it's 85,000 rupees. Is that clear? Opening stock is usually added to purchases. So in that case, purchases is debited, opening stock is credited. In case of closing stock, it should be subtracted. In this case, closing stock is debited and purchases is going to be credited. By passing this entry before the trial balance preparation, then automatically what happens? The opening stock in the trial balance disappeared. Closing stock will now become a part of the trial balance item. Is that clear? Let's see. The journal entry for the opening entry, opening stock. Okay. For opening stock, what happens? You have to debit the purchases account. Purchases account debit to stock opening. And for closing stock, what is the journal entry? Stock closing, and it should reduce the purchase. To understand a small logic, I will give you here. Purchases 10,000. We have opening stock 2,000, and we have closing stock 5,000. What does it mean? We purchased 10,000 rupees worth of goods in the beginning in this year. Already we have 2,000 rupees worth of goods in the beginning. Overall 12,000 goods available with us. But year end, we go and physically verify the stock available in the godown. We find it's only 5,000. 12,000 minus 5,000, 7,000 rupees worth stock is now missing. Missing means that 7,000 is nothing but what? Cost of goods sold. Okay, cost of goods sold. To the extent of sold items cost. Okay. Now, usually we name this being adjusted purchases. This is otherwise named as adjusted purchases. What is that? Opening stock is added with the purchases and closing stock is subtracted. You will get the adjusted purchases. By passing these adjustment entry, you will get adjusted purchases is a part of nominal account. And purchases may be real account also. May be real account or nominal account. Usually real account, because whatever the payment you do, for that the benefits enjoyed within the specific year, then it's a nominal account. Enjoyable later, real account. Right. We purchased, remains unsold, may be saleable in the next year. So as on 31st March, the payment still worth to be enjoyable later on, then it's an asset. Asset means the real account. Is that clear? So in both the classifications are possible. Purchases may be either real account or nominal account. In general, the actual purchase is a real account after adjusting the opening stock and closing stock to the extent of purchased item sold. Hereafter, we cannot enjoy that sold purchases item. In the later period, I can use this for the revenue generation, not this one, because there is no more my item sold already. So the benefit is already arrived and it's a nominal account. For this extent benefit to be receivable in the next period, then it's a real account. Is that clear? That's a logic. Now, let me start with the basic logic to understand this illustration. Thereafter, I will explain this in detail along with the adjustment entry and then other things also. Right? Let's see. Okay. Now, yes, here is find out the assets first of all, and find out the expenses. Purchases expenses, carriage inward expenses, advertisement administration expenses, selling expenses, fixed assets, investment asset, debtors asset, cash assets, opening stock expenses. Because opening stock could have been sold in this year, so it is an expenses. Sales, income, capital, 10% loan and creditors are the liabilities. We have closing stock. Closing stock should be posted twice. That you know. Okay. Let me see how to work out this illustration easily. There will not be any complications. Prepare the trading and P&L account and then balance sheet. Okay. Now, trading and P&L account, trading and P&L account, and then balance sheet. Is that okay? In these expenses, again, you have to segregate that whether the expenses related to the trading account or P&L account. Okay, purchases being trading account. So until what happens? Until bring it to your own showroom, ready for the intended use, will come under this case. Okay, this one. After this one will be considered as trading account item, purchasing and bringing it to seller's place. Okay, so that will be the trading account. Let's see. Now, carriage in, without that the goods will not come to your place. Administration, it's a regularly we are going to do. It's not part of trading account. Then it's a P&L account. Selling expenses also after the purchase only happens. So P&L account. Sales, predominant income. So trading income. Now in trading we have three items here. Debit directly goes to the debit side. So here you see. Okay, two purchases. Value being 5,000. Carriage in 1,000. Administration expenses will be the second block. P&L account, admin expenses. This value being 1,000. Selling expenses, this value being 1,000. And fixed assets, part of the balance sheet, fixed asset, this value being 4,000. 12% investment, already I named this being asset, so this is asset side, this is liability side. Okay, asset side and liability side. 12% investment will come here, the value being 2,000. And debtors asset side, the value being 1,000. Cash asset side 1,000. Opening stock expenses, that too will be a part of trading item. So here opening stock, the value being 1,000. Then trading item sales, revenue side, so credit side by sales, the value being 7,000. Capital, loan and creditors will come in the balance sheet, so capital here being 5,000. 10% loan, the value being 4,000. Creditors 1,000. When it's being the adjustment, it should be posted twice. One is in the credit side of the trading account, closing stock. Another one being in the asset side, closing stock. That's how we usually study and solve illustrations, but the logic behind I may explain a bit later. Right, why do we do so? Now finish up tallying this. By tallying this, you'll get first block tally. By tallying the first block, I'll get the GP of rupees 3000. Here GP 3000 rupees. That GP is transferred to the next block. Clear? Now by tallying the second block P&L account, whatever the balance you identify is the net profit. Net profit is nothing but result of taking up this business. Who is running this show? Owner. Owner is named as capital, so this money is for the owner only. Net profit is going to be added here. Either it may be added or simply name this being the P&L account. Now find out the total. The total being 11,000. Huh? Yeah, 11,000 rupees. 11,000 rupees. Now, in this case, I am going to guide you the transfer entries. Okay, because transfer entry model is followed. So, I am going to pass a transfer entry. So, what are the requirements? You have to pass a transfer entry. Let's see. Right. These two are the items transferable to the trading account debit side. Right. So, for this, you need to pass one transfer entry. For this, you have to pass one transfer entry. This one also be clubbed with this one. All the trading debit side item. And for this, one more transfer entry. So, I am going to pass almost three transfer entries. One is all about the items related to this one. What are they? Purchases, carriage in, and opening stock. Second transfer entry is all about these two, admin and selling and distribution. Third transfer entry is all about sales and closing stock. Sales and closing stock. We can either pass these two entries separately or combinedly, no problem. So I may pass the entry for this separately, for this separately. Is that okay? How should be the transfer entry? How should be the transfer entry? Okay, I write here. Now, for these two, it should be debited to the trading account. Am I right? So, trading account debit, to purchases, to carriage in. The value being 5,000 and 1,000, 5,000 and 1,000, 6,000. Entry for this is passed. Entry for these two are debited to the P&L account. So P&L account debit to admin, to selling, 1,000 and 4,000. Total being 5,000. For this, entry is passed. For opening stock, should also go to a debit side of the trading account. It means it should be cancelled. Cancelling means automatically all these items will be in credit. In which account it goes now? That account should be debited. Here, I am going to debit trading account to opening stock. The value being 1,000 rupees. The value being 1,000. Is that clear? Clear? And here we have sales. Sales is in credit side. To cancel means we are transferring now. The sales is debited so that it will be cancelled. As it is going to be debited, which account is going to be credited? Either it may be trading or P&L account. Naturally, it is trading account item. So sales account debit to trading account. The value being 7,000. So we have passed the entry for this one and this one. Finally, for closing stock. For closing stock, the journal entry being, it is going to be subtracted. It is going to be posted the credit side of the trading account. So then the entry being here, closing stock account debit, new account comes to trading account. The value being 3,000. Okay. And of course, for the GP, you can pass a journal entry. What is journal entry for the GP? Hmm? Trading account debit to P&L account. Trading account debit to P&L account. That's how you can pass the entry for this 3,000, 3,000. Now, what is the journal entry for the net profit? P&L account debit to capital account. Okay, hope you will be now you will be able to understand the transfer entries logic. Okay, so we have completed this part. This part. Opening stock and closing stock. Not only that, for all other assets, means all other items transferable also be recorded in the transfer entry here. Clear? Of course, these transfer entries are rare while preparing the advanced level illustrations. But as you are being the professional student, you need to understand logic. What is called transfer entry? Don't memorize. Closing stocks are put that value in the credit side of the trading account and post that in the asset side of the balance sheet. No, that's how you should not memorize it. Okay, you have to understand the logic behind. What is the journal entry for that? Okay, so that I have covered here. Next, rather than the transfer entry, we can of course pass the adjustment entries also for the closing stock. If you pass the adjustment entry, then how the trial balance gets affected? Shall we go for that next part here now? Yeah. Any doubts? No, no doubts, right? Now, let's see. I'm going to pass the adjustment entries now. Adjustment entry. We have only one item in adjustment. Adjustment entry is nothing but the entry is required to be passed for adjusting some advance outstanding and depreciation. Those items not recorded as on 31st March of the financial year, but not already recorded. So we need to do some adjustment. That's called adjustment entry. Closing stock. When we pass the adjustment entry for the closing stock, always remember we are going to adjust the purchases, opening stock also. Opening stock also. Now what happens here? Adjustment entry. For closing stock, that closing stock should be subtracted from the purchases. Purchases the debit balance, to subtract or to reduce should be credited, right? So two purchases. Okay. Two purchases, sorry. If purchases is going to be credited, which account is going to be debited? This closing stock account. Okay. What is that? Closing stock. Always remember, if you are going to pass the adjustment entry for the closing stock, remember you have to adjust for the opening stock also simultaneously. You have to adjust for the opening stock also. For the opening stock, what happens? It should be added with the purchases. So purchases account is going to be debited to stock. What stock is that? Opening stock. The value being 1,000 rupees we have here. Okay. Now I asked you to prepare the trial balance after these two adjustments. How the trial balance will appear? How the trial balance will appear? Let's see. Let's see. I may open the purchases account and stock account. Purchases account and stock account. Clear? Purchases shows debit balance, so put the value in the debit side balance. Opening stock appears in the debit side, put that value in the debit side balance. Clear? Now we have passed two adjustment entries. I am going to post these things in the concerned ledger account. Stock account. In stock, two purchases, the value being 3000, the value being 3000. Purchases by stock, the value being 3000. Here purchases to stock, the value being 1000, and here stock will be posted here purchases 1000. After this, what happens here? You have balance of purchases account being 3000. This balance carried on will come here. How much? 3000. Hope now you'll be able to understand how this gets up changed. And on tallying the stock account, you get the balance of rupees 3000, balance carried on. So this becomes 3000. Usually we no need to say this being the opening stock or closing, simply stock. If there is no any adjustment related to the closing stock below the balance sheet, forget. What are the stock given in trial balance itself? Usually closing stock. Usually closing stock. Then it will directly go to the balance sheet asset side only. Cross verify whether the trial balance has opening stock or closing stock. Nothing stated. Nothing stated. If it is opening stock, that you may understand easily. Transfer to the debit side of the trading account. Closing stock directly transfer to the balance sheet asset side, but nothing stated. What you can do, go and see the adjustments. On referring the adjustments, you find if there is no stock adjustment, the stock given in the trial balance represents only the closing stock. Only the closing stock. Is that clear? Now, I am going to post the journal entry for this one. This is called completely adjusted trial balance. This is called completely adjusted trial balance. Completely adjusted trial balance. Let's see. This becomes 3000. This becomes 3000. This one is cancelled complete because already recorded. Now from this trial balance is called adjusted. I hope so. You will now understand how this type of trial balance may be appearing. Okay, this is called adjusted trial balance. Now I have to prepare the final accounts from this. Final accounts has three components here. Okay, trading account, P&L account, and then balance sheet. Okay, trading and P&L account, and then balance sheet. Yeah, purchases, trading expenses, carriage, trading expenses, administration, profit and loss expenses, selling expenses is being the profit and loss expenses. Fixed asset, 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 asset. It is not opening or closing, simply stock. Then it becomes asset because closing stock already disappeared. Sales, trading income, capital, and rest of these two are the liabilities. In trading account, left hand side is debit and right hand side is credit, and in balance sheet, right hand side is asset and left hand side is liabilities. Liability consisted of two items, liabilities and capital. Okay. Now I'm going to post everything one after one. Yes. Purchases, carriage in. Two purchases, the value being 3000. Carriage in, the value being 1000. Administration and selling expenses, the value being 1000 each. Rest of all the items are assets, so I post that in the asset side. Fixed asset 4000, 12% investment 2000, debtors 1000, cash 1000, and stock 3000. Clear? And in credit side, post that value in the credit side. By sales, the value being 7000. Capital, this, the value being 4000. And we have creditors, the value being 1000. Clear? We have posted everything. Now I am going to solve this illustration. Tally the trading account and find out the balance item. That balance is named as gross profit. Gross profit in this case being 3000. By gross profit 3000. By tallying the P&L account, I'll get 1000 being net profit. This net profit is added with the capital. Totaling the balance sheet gives me a total of rupees 11,000. Sir, don't we pass the transfer entry, sir, here? Yeah, of course you can pass the transfer entry also. If you want to pass the transfer entry, you have to pass the transfer entry for what? These two, and this one. Only these three. Okay. Assets and liabilities capital, we no need to pass any transfer entry. What about the adjustment entry? Already passed. Because of passing the adjustment entry related to the stocks, the revised balance sheet appears this way. In your examination, always cross verify whether it's a trial balance without adjustment or after adjustment. Okay, without adjustment means all the things are given in the adjustments. After adjustments means nothing will be there below the adjustments, right? So that's how you can understand easily. Now, the transfer entry for these two. These two debit items are going to be cancelled on transfer. So it should be credited, and where it is going to be recorded, no, that account is going to be debited here. Trading account is debited. Trading account debited. To purchases, to carriaging. The value being 3000, 1000, 4000. Administration, these two also be debited to the P&L account. So P&L account debit to admin, to selling, 1000 each, 2000 rupees. And for this should be credited to the trading account. So sales account is going to be debited. Sales account is going to be debited. Okay. To trading account. To trading account. The value being 7000. Okay. Yeah, of course you can pass a journal entry for the GP as well as net profit also. Okay, for the GP, the entry being profit and loss account debit to trading account. This one, profit and loss, okay. Trading account debit to, trading account debit to P&L account. Here, P&L account debit to capital. That's how you can pass it. Clear? Any doubts here? Hope you will be able to now understand the logics here. Okay, adjustment entries. So either you may follow this model or this model. There may be doubt. Okay, whether the trial balance is adjusted one or unadjusted one. Go on, simply refer. If the adjustments given below the trial balance, then this model is followed or this model is followed. Now you need to understand how from this model to that model came. For that you have passed the adjustment entry. Clear? Practically this entry is very rare, but of course while working in any accounting software, this entry is very much important. I solved one illustration using the manager software, free accounting software. You can use it for a small business. I already told you. Tally, like all the software are pretty expensive. You have to pay around 10,000 rupees something per annum subscription fee. renewable at 5,000 or something. Some value is there. But this is free software. You can use the free software there also for adjusting the closing stock. This entry is passed. Go and refer. Go and refer. Is that clear? Any doubts here? So I have posted both the methods here. Now we have set up a few other adjustments also to be done here. Okay, what are they? So we have been given almost 8 adjustments rather than 1. What are the requirement? Pass adjustment entries, prepare adjusted trial balance, prepare final accounts from the adjusted trial balance. Anyhow, I may guide this one later. Usual simple model we will follow. Practically in our examination we follow that one only. But you have to understand the complete logic so that the requirement, pass adjustment entries, prepare adjusted trial balance and prepare the final accounts from the adjusted trial balance can be done in the next class. Okay. What's the simple point you have to keep in your memory here? Right. Let's see. Let's see. Now, in simple point. In case of closing stock, that you know, what is that? Trading account credit and P&L account, balance sheet asset side, right? So the value being 3,000. Apart from that, in case of outstanding expenses, okay, add with the concerned expenses and post that in the liability side. Okay, add with the concerned expenses and post that in the liability side. This is a simple rule. In case of expenses paid in advance, expenses in advance should be subtracted from the concerned expenses, okay, and post that in the asset side. Clear? In case of accrued income or outstanding income, add with the concerned income and post that value in the asset side. And income received in advance, in case of income received in advance, it should be, now income received in advance should be subtracted from the concerned income and should be a liability here. These are the things you have to understand. Closing stock, you know, outstanding selling expenses, advance administration expenses, commission receivable and rent received in advances. So these are the 4 items. Now let me explain what is the logic behind. What is the logic behind? Okay. For example, rent rupees 10,000 per month. Rupees 10,000 per month. But rent paid rupees 10,000. What does it mean? 1 lakh. Rent paid per month is 10,000, but rent per month, the rent payable per month being 10,000 as per the terms of agreement. But you paid only 1 lakh. You occupied the possession of the property for the entire 12 months. 12 months you occupied, but you paid only 1 lakh. Per month 10,000 means for the 12 months how much you have to pay? But you are not paid. Then the shortage 20,000 is called outstanding. Now if I ask you what is the rental expenses, will you say 1 lakh or 1 lakh 50? As I already told you, if you go to the restaurant, you order. The moment you order, the food is started preparing, then automatically your expenses whether you eat or not. Some emergency, you have to come out, whatever it may be, you lost that money. Okay, similarly, you enjoyed the 12 months now, it's your commitment to pay that. So 1 lakh, another 20,000 is outstanding, should be added. But if it is paid, then it may be subtracted from the cash or bank, but it's not paid. Then it's your liability to pay to the landlord, owner. That's why it is called liability. Outstanding rent. Outstanding rent is a representative personal account. Representative personal account. If I say outstanding rent is there, go and pay 20,000 rupees. To whom you will go and pay? To the landlord. You know that outstanding rent means you have to pay to the owner only, landowner. Outstanding rent payable to them only. Outstanding rent. Is that clear? Outstanding rent. Representative personal account. Clear? Suppose the actual rent paid being 1,30,000 rupees. What does it mean? Okay, per month 10,000 for the 12 months, 1,20,000 is paid. So if the rent paid being 1,30,000, for that period is only 1,20,000. Per month is 10,000 rupees, means per annum 10,000 into 1 lakh. So 10,000 into 12 months, 1,20,000 should be there. 1,20,000 should be there. Is that clear? So the another 10,000 rupees may be paid in advance. Paid in advance. Actually, your expenses is only 1,20,000. For that period, what is the real expenses could be should be identified. That amount will be transferable to the P&L account. Anything excess payment or underpayment should be adjusted for the 12 months period. If there is any excess payment, then we have the benefit to be enjoyable in the later period. That will be asset. If you have paid lesser, then it's a liability because you are liable to pay the rest in the next period. Anyhow, the expenses for the period is 1,20,000 rupees. So you have to understand how to adjust all these things: outstanding selling expenses, advance administration expenses, commission received, and rent received in advances. All the 4 items. Okay. So closing stock we have seen. So I have just given a small briefing about this one. So we'll finish up the rest and completely this question number 2 in the next class.